Hi guys, welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about the 7 top stocks to buy and hold forever. So make sure to watch the full video. 1. Amazon.com. Industry, Internet Retail, Market Value, $1.2 trillion. Amazon.com, AMZN opens a new tab, $118.01. Made news this year by undergoing a 20-for-1 stock split. But the optimism of that announcement has quickly faded as the shares have slumped. AMZN stock is now trading about 40% below its all-time highs and has given back most of its COVID-era gains. The shares are only marginally higher than they were in the summer of 2018, 4 years ago. But here's the thing. This isn't the first time Amazon has taken a tumble. The shares dropped by more than 30% during the late 2018 market correction and lost a quarter of their value or more in 2011, 2014, and 2016. And then, of course, there was 2008, where the shares lost nearly 2/3 of their value. Every time AMZN hit a rough patch, it came back stronger. Naturally, today's Amazon is a larger, more mature company than the brash internet startup it used to be. It's also struggling with growing pains typical of a company its size, such as labor unrest and political pressure. But let's ask ourselves a couple questions. Do you buy more or less on AMZN stock today than you did 5 years ago? And do you expect that you'll be buying more or less 5 years from now? Apart from being the leading internet retailer, Amazon remains the #1 player in cloud computing services via its AWS platform. The shares trade at 2.5 times sales. That's ever so slightly higher than the S&P 500 at 2.3. However, while that's not cheap in a traditional value sense, it's close to a 6-year low for Amazon. And that might be an attractive entry point in what could be one of the best stocks to buy for the rest of 2022 and beyond. 2. Alphabet. Industry, Internet Content and Information. Market Value, $1.3 trillion. Like Amazon, Google parent Alphabet, Google, $100.05, also recently underwent a 20-for-1 stock split, which happened on July 15. And as is the case with Amazon, the shares have really struggled ever since. Google shares are down by over 1/3 from their 2021 highs, erasing nearly 2 years' worth of gains. Even after the tumble, Alphabet shares are not cheap in a strict value sense, as they trade hands at 4.8 times sales. But that's down considerably from a price-to-sales ratio in the 8s over the past year or so. And looking at Google price-to-earnings ratio, the stock trades at a not at all unreasonable 18 times trailing earnings. If there was ever a stock to justify a high multiple, it would be Alphabet. Despite the company's gargantuan size, it still enjoyed quarterly revenue growth of 13% last quarter and a fat return on equity, ROE, of close to 30%. One more thing about that, Google shares have only dipped to these levels a handful of times in the Alphabet's history as a public company, and every time they did, they came roaring back. 3. PayPal Holdings. Industry, Credit Services. Market Value, $105.4 billion. Anything even remotely related to fintech or distributed finance has had a terrible time in 2022. And some of this weakness is justified. While the financial sector is ripe for transformation, the speculation in cryptocurrencies got out of control. El Salvador essentially called the market top in Bitcoin by making it legal tender in September of last year. It peaked 2 months later and has been in free fall ever since. But here's the thing. The baby was thrown out with the bathwater. Yes, cryptocurrency might not quite be ready for prime time, but the world of finance is still very much ripe for disruption. And PayPal Holdings, PYPL opens a new tab, $91.12, is one of the best established players in this developing new ecosystem. Apart from PayPal's own namesake payment system that is ubiquitous on websites, the company also owns the popular Venmo mobile app. Venmo is the preferred payment app for many young people and is popular with gig workers. PayPal's shares are now down close to 70% from their recent highs and trade for 4.1 times sales. That's close to the cheapest they've been in PayPal's entire history as a public company. For Allbirds. Industry, apparel retail. Market value, $491.4 million. Let's step away from big tech for a minute. 2021 was a big year for initial public offerings, IPOs, but many of the stocks that went public last year have really struggled in 2022. As a case in point, consider the shares of eco-friendly shoemaker Allbirds. BIRD opens a new tab, $3.30. Allbirds manufactures and markets athletic and casual shoes made primarily out of wool and plant-based materials. The company even developed a carbon-negative foam to be used in its shoe soles, meaning that the production process actually removes carbon dioxide from the atmosphere rather than adding to it. It's a novel company selling trendy, popular shoes that recently became available in Nordstrom stores. Yet none of that seems to matter in 2022. The shares are currently 90% below their 52-week highs and nearly 80% below their $15 IPO price. Bird is more speculative than many of the other best stocks for 2022 covered here. It has a market cap of less than $500 million and is not yet profitable. But it's worth noting that institutional investors have a preference for companies with strong environmental credentials. And it's hard to find too many companies with stronger environmental bona fides than Allbirds. And with a market cap as low as Allbirds' current valuation, the company could also be a takeover target for a traditional apparel retail name looking to boost their image. 5 Dutch Bros. Industry, restaurants. Market value, $5.5 billion. For another recent IPO that has really struggled in 2022, consider the shares of Dutch Bros. BIRD opens a new tab, $33.82. Founded in 1992, Dutch Bros is an operator and franchisor of drive-through coffee shops specializing in espresso-based drinks. As of year-end 2021, the company had 538 locations spread across 12 states, and it plans to open at least 130 stores by the end of this year. This is a tough environment for companies in the food and drinks business. Labor is expensive and hard to come by, and inflation has been unrelenting. And there is the broader risk that the combination of a slower-growing economy and rising prices will cause consumers to pull back. Hat might be true. But expenditures on little luxuries, such as premium coffee, tend to be pretty recession-resistant, as they offer a cheap escape from life's frustrations. BIRD stock is currently down nearly 60% below its 52-week high set shortly after its late 2021 IPO. It also trades at 3.0 times sales. That's a reasonable valuation for a high-growth company looking to increase its store count by 24% this year. 6. Walt Disney. Industry, entertainment, market value, $181.2 billion. Walt Disney, DIST opens a new tab, $99.40, has really taken a lot of abuse this year. Increased competition in the streaming video space has made its Disney Plus growth story look less compelling. Inflation and labor shortages haven't helped either, nor has a nasty public spat with the state of Florida that saw the company's special tax status come under attack. All of this has contributed to the shares losing more than half their value from their 2021 highs. But we shouldn't underestimate Mickey Mouse. Disney is the premier name in family travel and entertainment, and owns some of the most valuable media properties in history in the Marvel Cinematic Universe and Star Wars. And after the tumble in the share price, Disney trades at prices first seen in 2014 and at a forward ratio of just 18. It's very possible that the Fed's aggressive rate hikes will push the U.S. into a nasty recession. We can't rule that out. And if that were to happen, Disney might see a modest dip in park attendance and spending. But this clearly isn't Disney's first rodeo, and the company has survived and thrived throughout numerous recessions in its decades as a public company. We can't say for sure when the bottom will be in. But it's not every day that you get to pick up shares of the world's premium entertainment company at half price. 7 Nvidia. Industry, semiconductors, Market value, $317.4 billion. Dividend yield, 0.1%. The tightness in the chip market is a major source of frustration for makers of everything from cars to home appliances, and it has been a contributing factor to the inflation inferno that's been raging out of control for all of 2022. But it also presents an opportunity for top chip makers to boost output and take advantage of strong pricing. Leading graphics processing unit, GPU, maker NVIDIA. NVDA opens in new tab. $127.36 is particularly interesting here because its chips are critical to some of the biggest trends in computing today, including artificial intelligence, autonomous driving, and cloud computing. The 2022 recession may accelerate from here, or it may not. It certainly can't be ruled out. But regardless, the trends driving NVIDIA's growth remain firmly in place. In fact, investment in artificial intelligence and cloud computing might actually accelerate in a recession as a way to cut punishingly expensive labor costs. NVIDIA is insanely profitable for a hardware company, with an ROI of 34% over the past year and net margins of 26%. Those are software numbers from a hardware stock. NVDA shares have dropped by nearly two-thirds since late 2021, and we can't know for sure when the bleeding will stop. But the business has never been stronger, and it's not unreasonable to expect NVIDIA to swing back and become one of the best stocks to buy for the rest of 2022. 8 Lowe's. Industry, home improvement retail. Market value, $120.7 billion. Dividend yield, 2.2%. Houses are wildly expensive these days for a host of reasons, but at the end of the day, it really comes down to supply and demand. The supply of new homes has simply not kept pace with demand due to natural population growth and to the millennials finally settling down and starting families. At the same time, soaring mortgage rates have made already expensive homes all but unaffordable to a lot of would-be buyers. This creates challenges, but it also creates opportunities for hardware and home goods stores like Lowe's. Lowe opens a new tab, $194.53. Homeowners, and particularly millennial homeowners, have been investing in their homes. Fully 75% of millennial homeowners started a home improvement project during the pandemic. But even in the post-pandemic world, demand for home improvements has remained strong. Many new homeowners are choosing to buy older homes as the inventory of new homes had simply not been able to keep up with demand. Lowe's is down about 26% from its highs, and at current prices, shares trade hands for 15 times earnings and yield 2.2%. About that dividend, Lowe's just raised it by 31% earlier this year. There's no greater sign of confidence by management than an aggressive dividend hike. Companies have a natural tendency to hoard cash, so they're generally not willing to part with it via dividend payments unless they see a lot more coming in to replace it. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.